Hey everyone, welcome back to Corporate Decoder. Today we're diving into a massive filing from AB Variable Products, Series Fund Incorporated. Normally these types of reports are less about a catchy story and more about the nitty-gritty details. But trust me, even in the world of mutual funds and investment companies, there are some surprisingly revealing numbers tucked away. And let's just say, the performance numbers we found might not be what every investor was hoping for in 2025. So buckle up as we decode this report to see how these funds performed, what steered their trajectory, and what it all means for the folks who entrusted their money to them. Before we jump in, if you love getting the real story behind corporate filings, make sure you're subscribed and hit that notification bell. And hey, we've got a fantastic community growing over on our Discord channel, linked in the description below, so come join the conversation. Alright, let's get into the nitty-gritty of this N-CSR filing. The main point here is to look at how the AB Variable Product Series Fund incorporated, specifically its various portfolios, fared in 2025. This report is essentially a shareholder update, and we're going to sift through the financial tables and performance analysis to find the key takeaways. We're looking at a whole range of portfolios here, from dynamic asset allocation to international value, and even small cap growth. The bottom line for most of these seems to be a consistent theme. They underperformed their benchmarks in 2025. Let's start by looking at the costs associated with investing in these portfolios. For instance, the class of shares of the AB VPS Dynamic Asset Allocation portfolio had costs of $91, which was 0.85% of the investment. Then Class B shares for the same portfolio cost $117 or 1.10%. These numbers are important because they show you how much of your investment is going towards managing the fund, not directly into investments. Now, let's talk performance for the AB BPS Dynamic Asset Allocation portfolio. The report says it underperformed the MSCI World Index, largely due to its 60% equity and 40% fixed income balance. They mention an overweight to equities and US Treasuries, which sounds like a reasonable strategy given economic expansion at the start of the year, but then tariffs were announced, volatility increased, and they de-risked. Even after re-risking, the performance just couldn't keep up with the benchmark. Looking at the table for class of performance here, in 2025, a $10,000 investment grew to $17,109. That sounds good, right? But compare that to the MSCI World Index, where that same $10,000 would have grown to $31,532. That's a massive difference. The blended benchmark did better too, reaching $21,598. Still, significantly outperforming the class shares. When we look at the average annual total returns, the difference becomes even clearer. For Class A, the one-year return was 13.54%. The MSCI World Index, however, delivered a whopping 21.09%. That means over the long haul, the fund is consistently missing out on significant gains compared to a simple broad market index. They mentioned that the volatility cap and currency selection detracted from performance, and in terms of holdings, companies like Nvidia Corp and Apple Incorporated were their top holdings, representing a good chunk of their net assets. These are generally strong companies, but clearly their specific strategy of balancing things out held them back compared to a more aggressive growth approach. Let's shift gears and look at the AB VPS Balanced Hedged Allocation portfolio. This portfolio also underperformed the MSCI All Country World Index, though it did better than the Bloomberg US Aggregate Bond Index. The report states that options detracted from performance, but overall risk management techniques contributed, along with equities and fixed income. For class of shares here, a $10,000 investment grew to $19,690 in 2025. Again, this sounds positive on its own, but the MSCI All Country World Index saw that $10,000 grow to $30,302, a significant gap. The average annual total returns show a similar pattern. Class A had a one-year return of 17.71%, while the MSCI ACWI benchmark delivered 22.34%. This shows a consistent underperformance that's worth noting for investors. What's interesting here is the top holdings. They have a huge chunk of their net assets in ETFs like the iShares Core S&P 500 ETF and iShares Core US Aggregate Bond ETF. This indicates a strategy heavily reliant on other investment vehicles rather than individual stock picking in some cases. Now, let's check out the AB VPS Relative Value portfolio. This one also underperformed the Russell 1000 Value Index, with security selection being the main culprit. They noted weaker selection in technology and communication services. Here, Class of shares saw a $10,000 investment grow to $27,313 in 2025. That's a decent number, but the Russell 1000 Value Index turned that same $10,000 into $39,827. The S&P 500 index also did much better, growing that initial investment to $33,786. Looking at the average annual returns, their class of shares achieved 10.47% over 10 years, which is respectable, but lags behind the S&P 500 index at 14.82% and even the Russell 1000 Value Index at 10.53%. It seems a recurring theme of not quite hitting the mark compared to market benchmarks. Moving on to the ABVPS International Value Portfolio. For this international focus fund, they actually outperformed their benchmark, the MSCI EAF Index, which is a positive sign. They attribute this to strong security selection within technology and financials and good country allocation, particularly in Korea, Japan, and Spain. However, sector allocation detracted from performance, with mentions of overweights to communication services and energy. For class of shares, the $10,000 investment grew to $19,025 in 2025. While this is a good return in isolation, the benchmark MSI EAF Index saw that same investment grow to $21,959. So even though they beat the benchmark here, the overall market growth was still stronger. Their one-year return for Class A was an impressive 41.70%, significantly beating the MSCI EAF Index's 31.22%. However, looking longer term, the 10-year return for Class A was 6.64%, while the MSCI EAF Index delivered 8.18%, showing that over time, the benchmark has generally provided better returns. Next, we have the ABVPS Large Cap Growth Portfolio. This portfolio underperformed the Russell 1000 Growth Index, with security selection being the main reason. They specifically mention weaker results in consumer discretionary, financials, and healthcare. Here, a $10,000 investment in class, shares grew to $44,770 in 2025. That sounds fantastic, but again, the Russell 1000 Growth Index turned that $10,000 into $52,906. A substantial difference, highlighting that a focus on growth didn't translate into outperforming the growth index itself. The average annual returns are even more telling. Their class of shares had a 10-year return of 16.17%, which is pretty good, but the Russell 1000 Growth Index managed 18.13% over the same period. It seems that while they hold strong growth companies like Nvidia Corp and Alphabet Incorporated, their specific strategy is leaving some potential gains on the table. Now let's look at the ABVPS Small Cap Growth Portfolio. This one also lagged behind its benchmark, the Russell 2000 Growth Index, with security selection being the main culprit. They cite weak performance in consumer discretionary and healthcare as key detractors. The numbers here are quite stark. For class of shares, a $10,000 investment in 2025 grew to $29,077. That is a loss from the previous year in this table. Now compare that to the Russell 2000 Growth Index, which saw that initial $10,000 grow to $24,949. It appears my earlier assessment might be slightly off, as the index actually saw a decrease in value from $22,077 in 2024 to $24,949 in 2025. So the fund's loss of $29,077 from 2024 to 2025 sounds like it might be a typo in the report, because the fund's value in this table actually went up from $23,386 in 2023 to $29,077 in 25. This suggests the fund, despite underperforming the index, actually had better absolute performance in some areas. Let me reread the performance again. Yes, the table shows the fund's value at $29,077 in 2025, while the index's value at $22,077 in 2024 and $24,949 in 2025. But not as much as the index. The average annual returns show a 10-year performance of 11.26% for Class A, while the Russell 2000 Growth Index achieved 9.57% over the same period. This is a notable exception where the fund has outperformed its benchmark in the long term, even if the most recent year was a bit rough. It seems their small cap strategy might have some legs. Let's check out the ABVPS Discovery Value Portfolio. This portfolio underperformed the Russell 2500 Value Index, with security selection being the primary detractor. They mentioned losses in industrials and healthcare, but some gains in real estate and consumer staples. Sector allocation also detracted overall. For class of shares, a $10,000 investment grew to $22,714 in 2025. That is a respectable gain, but the Russell 2500 Value Index saw that same investment grow to $25,291. Not a huge gap, but still an underperformance. Their average annual returns show a 10-year return of 8.55% for Class A, which is close to the Russell 2500 Value Index's 9.72%, so their value strategy seems to be performing reasonably in the long run. Finally, we have the ABVPS Sustainable Global Thematic Portfolio. This fund underperformed the MSCI All Country World Index, with security selection in technology, financials, healthcare, and consumer discretionary being cited as primary drivers of the shortfall. They also note currency forwards detracted from performance. The class of shares saw a $10,000 investment grow to $26,127 in 2025. That sounds okay, but the MSCI All Country World Index saw that investment grow to $30,302, a significant underperformance here. Their average annual returns show a 10-year return of 10.08% for Class A, but the MSCI ACWI benchmark delivered 11.72%. While they mention sustainability in their name, it's important to remember that even with these criteria, performance still matters. And in this case, performance is lagging. So what is the overall picture here? Many of these portfolios, particularly those focused on large cap and dynamic allocations, have consistently underperformed their benchmarks in 2025, while some international and small cap growth strategies showed relative strength or better long-term performance. The overall trend suggests potential issues with either security selection or the specific asset allocation models used. The high concentration of holdings in some of these portfolios, like the large cap growth portfolio holding nearly 55% of its net assets in its top 10 holdings, amplifies the impact of each individual stock's performance. While these are often well-known, companies like Nvidia Corp and Microsoft Corp, relying so heavily on a few names can be risky. They do mention management risk as a factor in the notes, which is key. Even with sophisticated models and experienced teams, investment management is not an exact science, and the ongoing war for talent in the tech sector can strain even the best firms. The company also points out that their past performance is not a predictor of future results, which is a standard but important disclaimer to keep in mind. When we look at the overall strategy, feels like they're trying to balance growth with some risk management, but in a year where certain sectors and growth-oriented indices really took off, this balanced approach might have been a drag on returns. For investors, understanding whether this underperformance is a short-term blip or a deeper issue with their investment philosophy will be crucial. That's our breakdown of these diverse AB variable product series fund filings. What are your thoughts on these numbers and what they might mean for the future of these portfolios? Let us know your opinions in the comments below. If you found this analysis valuable, please give it a thumbs up and remember to subscribe and hit that notification bell so you don't miss our next deep dive. Also, make sure to check out the Discord community linked in the description. It's a great place to connect and discuss these topics further. Thanks for watching, and we'll see you next time on Corporate Decoder.